Good afternoon to all of you. On behalf of the Accounting Standards Board, it's my privilege to welcome you to today's webinar, Year-End Considerations, Assets and Liabilities, Ind AS Compliance for Financial Year 2025-26 Finalization. The year-end financial closing process is a critical phase in financial reporting where the focus shifts from routine accounting to the comprehensive evaluation of the recognition, measurement, and completeness of assets and liabilities. While Ind AS provides a robust framework, its effective application at year end often requires careful analysis, informed judgment, and alignment with underlying business realities. In practice, several complexities emerge during finalization, ranging from assessing impairment of assets, evaluating recoverability of balances, and determining appropriate valuation basis to recognizing provisions and other obligations with the right degree of prudence and accuracy. These areas are not merely technical in nature, but also require a disciplined approach to estimates and assumptions. Through today's session, we aim to address the practical challenges. The discussion will go beyond the principles laid down in Ind AS and focus on their application in real life scenarios, highlighting areas involving significant judgments and common pitfalls observed during the closing process. We are confident that this session will provide you with the structured and practical perspective, enabling you to approach the year-end finalization of assets and liabilities with greater clarity and confidence. We thank you for joining us and look forward to an insightful and engaging discussion. Before we move into technical discussion, it's my privilege to introduce the moderator for today's webinar, CA Nitish Agarwal. Nitish Agarwal is a chartered accountant with over 10 years of experience in assurance, accounting, and advisory. He has served clients across sectors with most of the time has been devoted to financial services. Formerly associated with one of the member firm of Big Four, he has also worked on assurance and advisory engagement internationally, including during his time spent in the UK. He brings together his passion for data, process optimization, and regulatory compliance to deliver well-rounded practical solutions to clients. Over to you, Nitish sir.
Thank you so much, Rahul. So very good afternoon to everyone, and many thanks to all those who have participated today. Thanks for sparing the time. I'd also like to extend our very warm welcome to Arijit ji, Mr. Arijit Chakrabarti, who's also a chartered accountant and has got a very rich profile academically and professionally. He's an alumnus of St. Xavier's College. He's a chartered accountant, an MBA in finance, a certified internal auditor, management and leadership program, Harvard, ISO lead auditor, Six Sigma black belt, aviation's operations and safety auditor, quality assurance reviewer. So I think definitely his number of qualifications exceed my years in practice. His professional experience is also close to 27 years. And his experience is in a very wide field of operations, and this includes assurance, financial reporting, risk management, vigilance, forensic due diligence, internal audit, strategy, cybersecurity, ESG, etc. in client entities from India, Bhutan, Bangladesh, Singapore, USA, Japan, Canada, Africa, Germany, UK, Afghanistan, and some other countries more. He has also been a lead consultant and auditor in World Bank for certain other ADB funded, which is Asia Development Bank funded projects, capacity building specialist associated with CAG office, the Ministry of Coal, Mines, Shipping, External Affairs, Defense, and some other more ministries and such other esteemed offices. He has served as the ASB, AASB, Digital Accounting and Auditing Board, IASB, CPGFM, Board of Studies, Indirect Tax Committee of ICI. He served as a resource person in all of these committees. He has developed and drafted 14 standards on internal auditing during the period 2008 to 2010 and has contributed to ICI's guidance note on CARO 2016 and 2020. He has been a technical reviewer for ICI Compendium of Internal Audit Standards 2026. He has been nominated as Advisor Audit Board under the auspices of the Office of CAG. He has trained many senior officers of the IAS cadre, IRS, IAAS, IP and TAS cadre, and he's been the visiting faculty at National Academy of Accounts and Audit. He's also pursued certain other authorship and other interests, which includes authored 9 publications on accounting, internal audit, business valuation, risk management, aircraft engineering, and martial arts. He's attained 7-degree black belt in karate, international instructor and examiner, represented India at World Karate Championships, conducted more than 500 stress management, fitness, and self-defense programs in schools, ICI, law enforcement agencies, and armed forces. He is also a light classical vocalist with music albums and trained pilot on Airbus A320 fleet of aircrafts. I think, I mean, Arijit ji, we've got a lot to learn from you, definitely.
Right.
Certainly something on the lines of how to do so many things in a single span of life.
No, I think I would only say that if you can complete your CA course, I think anything is achievable. And thanks to ICI, the blessings of the founders of the institute, our seniors, by virtue of which I was able to do some multitasking. Of course, I also had a science background, shifted from engineering to commerce. That's why I was able to pursue my dream of being a pilot. Also worked with the Big Fours extensively, Big Five firms at leadership levels, becoming country head of risk advisory with one of the Big Five firms. And then, of course, shifted to independent practice, developing new service lines, and of course, trying to contribute to the profession. Right.
Certainly your contribution is visible, sir.
Right. Okay. So we can start if you permit. Right.
Sure.
Okay.
I mean, we are really looking forward to a very engaging session. Given your vast experience, I'm sure you've got a lot that we can learn from.
Right. So I thank the Accounting Standards Board, the respected chairman, sir, vice chairman, sir of the Accounting Standards Board, all the officials of the ASB, in particular, CA Rahul Lavani, who's there with us, who was kind enough to initiate the session, and the moderator of today's session, CA Nitish Agarwal, who brings exclusively a lot of experience, if you must have seen, in accounting, auditing with the multinational firms, with Indian practice, as well as he's working in certain sectors like data analytics. So that is, I think, a great beginning to the session. And of course, I must wish everyone a very happy new financial year. And the 1st of April today marks a lot of changes. We are all aware that the Income Tax Act, the new act, is taking shape and it is getting implemented from today. Plus a number of areas we will see when it comes to the insurance sector, Ind AS for the insurance sector formally getting flagged. So I have started with the presentation. Let us first go and check the areas. Of course, the disclaimer is that the views I'll be presenting, a lot of questions are already there. I'll try to take as many questions as possible, which are already there, which have come to us. Yesterday, we received a very detailed query, and I will try and answer and explain the technicalities involved in that. But please note that this is absolutely my personal views. The disclaimer is that the views expressed do not represent the views of the ICAI or any of the committees. And of course, these are all based on practical experience, whatever I could gather in these few years. So we will first cover some of the recent updates in Ind AS. This year, 2025-26 has been quite eventful. In fact, if you remember, so many changes, Income Tax Act getting implemented, getting introduced, GST 2.0, then you can remember the new labor code. And as a result, there were certain changes in the definition of wages, and therefore Ind AS 19 gets hit. So we will cover those areas as well. But another landmark change has been that the IRDAI, the Insurance Regulatory Development Authority of India, has formally flagged the Ind AS roadmap. Incidentally, the insurance companies need to start implementing Ind AS from today. We will go into that. The main topic we are going to discuss is definitely the year-end considerations for the finalization of the statements, assets and liabilities. So there are some specific Ind AS which we will try to discuss, which are very relevant if you see for this particular financial year. And Ind AS 1, there has been a lot of changes regarding current and non-current classification. Ind AS 7 on cash flow statement, we shall be discussing the details of the SFA. So the supplier financing arrangements, sometimes also known as SCF. supply chain finance. Ind AS 8, yes, some changes are there. Ind AS 10 on events occurring after the reporting period. There will be certain consequential changes. And then we have Ind AS 19, this which I was mentioning. In fact, if you see the definition of the new, that definition of wages, and therefore the impact on the past service cost. And ICI already was one of the first, if you see when the new the labor code was introduced, ICI immediately came out with a clarification, a guidance regarding what to do with the past service cost. We will move into Ind AS 21 as well, and on the foreign exchange losses, foreign exchange differences, Ind AS 37 on contingencies, provisions, and ESC, the Expert Advisory Committee, has issued certain guidance on Ind AS 110 on consolidated financial statements. Plus, we will look at some of the ESC opinions, possible impact areas due to the ongoing geopolitical crisis, which will have a bearing on the accounts of financial year 25-26. And I will cover reference to the response to the detailed query we received through mail yesterday. In case studies, I will cover some of the PSUs just to have a quick look at some of the non-compliances as well as some really perfect or really high, I would say, model accounts. Lastly, time permitting, I will just dive not deeply into but we will cover some important observations of the NFRA. If you look at the January 9 circular, NFRA has underscored the importance of those charged with governance, audit, accounts, and overall the role of accounting, financial reporting in corporate governance, what should be the role of the board of directors, etc. We will cover that. And the recent, last month, 16th of March, the NFRA report, so far as the audit quality inspection AQI was brought out, we will cover that as well. And this is what we have. First is the Ind AS categories. Now, when we are talking about so many Indian accounting standards, plus we need to remember that as we have come to the end of the financial year 25-26, some new standards are in the pipeline. So taking stock of what are the important Ind AS. So if I think of the asset, liability, income and expenses, first, every company, now we are all currently very busy advising companies for the closing, quality closing and reporting. Of course, after a few days, we will start with the audit and it will be a very hectic experience for everyone. But then when we are talking to several clients, the fact that Ind AS is just a journey, not a destination. So many standards are coming in, new standards are coming, and existing standards are getting revised in line with the annual improvement goals of IFRS. As we all know, Ind AS is the Indian version of IFRS, and virtually it is now probably 99% equivalent to IFRS. And therefore, any change in IFRS necessitates a change in the Ind AS as well. So last year, several amendments have happened. So asset quality, asset-based standards, when we talk about the asset-based standards, so for CFOs and controllers, for finance managers, they need to create a checklist that, okay, standard-wise, what are the important checkpoints for compliance purposes, for disclosure purposes. And the first will be asset-based standards. We have some very critical standards, including 16, property, plant and equipment, investment property. And in the end, I will also cover some critical observations of the ICAI FRRB, the Financial Reporting Review Board. So we will see that the FRRB has issued some very serious observations on non-compliances with regard to Ind AS 16, Ind AS 40, and also Ind AS 38 on intangibles. So this is the asset-based standards. Then we have some very critical standards on expenses and liabilities. So you have income tax, deferred tax, and of course Ind AS 37, which we shall refer multiple times, in the session today. We will refer to Ind AS 12, Ind AS 37. Of course, we will also discuss some major changes in Ind AS 1 and 7. Reporting-based standards, of course, we have so many standards. In fact, essentially speaking, Ind AS 1, 7, 8, 10 events after the reporting period, these are essentially reporting standards. Ind AS 29, hyperinflationary economies, now becoming not a reality for certain economies, but maybe the way in which the geopolitical crisis is every day is casting a shadow on the entire corporate world. So hyperinflation could become, probably we could see some instances of hyperinflationary economy. So Ind AS 29, Ind AS 33 on EPS. Coming to disclosure-based standards, as we all know that Ind AS is not just focusing on the accounting, on the measurement, recognition criteria, but the overwhelming focus, thrust is on disclosure. And as auditors and consultants to several organizations, different categories of companies, it is always our primary aim to sensitize business houses that you have to be very specific on the disclosures. And we can see that disclosure-based standards, Ind AS 24, all of you have recently seen the observations of the NFRA, where the National Financial Reporting Authority has time and again focused on the fact that Ind AS 24, related party disclosure, has to be complied with. And as auditors, we need to check whether Ind AS 24 is getting complied. Similarly, another major standard, Ind AS 112, disclosure of interest in other entities for large companies with subsidiaries, associates, joint ventures, right? Then you have certain subsidiaries which may not be consolidated. There could be certain associates which are becoming subsidiaries in the course of the year. So this standard for finalization purposes will be critical. And of course, we have 107 on disclosure. Industry-specific standard, we will see in a while how Ind AS 117 on insurance contracts is making complete change in the insurance sector. And for the oil and gas, when we talk about the mining sector, Ind AS 106 is critically important. In fact, if you look at the industry-based standards, I think all of our colleagues here who are currently advisors, consultants, auditors to insurance companies, they are getting ready to check, to ensure whether the requirements of Ind AS 117 is actually implemented. Similarly, for the power sector, for rate-regulated entities, we have the RDA, Regulatory Deferral Accounts, Ind AS 114, very important for power sector companies, and even for those entities where the revenue is decided by tariff. Then last but not the least, please note how Ind AS is, I mentioned a little while back that Ind AS, as per my understanding again, is that it is a journey, it is not a destination. Why? Because we have new standards coming up. So the old IGAP accounting standards, that was fairly static. Yes, we had changes and amendments once in a while, but Ind AS and the new standards, we can see very frequent changes and additions. First and foremost, we have new standards coming up for sustainability. Now, the International Accounting Standards Board has already issued standards under the IFRS S for sustainability, S series. You have S1 on disclosure of sustainability related financial information and S2. Now, these two standards for large corporates, which are essentially transnational, multinational companies, these two standards, of course, are critical for finalization. And as part of the year-end considerations, these two standards may not be currently in India, but if you look at economies outside, yes, these two standards are actually going to challenge the entities, business entities, when it comes to data disclosure and also when it comes to interpretation. IFRS 18 has already been issued, as we all know, globally, and this deals with the presentation disclosure in financial statements. In India, we will see we have the Ind AS 118, which is going to replace Ind AS 1, right? IFRS 19 was issued in 2024, dealing with disclosure for subsidiaries. So as I was mentioning a little while back, if you look at the first block in this slide, disclosure-based standards. If you see the upcoming series of standards, essentially, again, as per my point of view, is that I was thinking that the new standards which are coming up, are they standards on accounting? Are they focusing on recognition? Are they very technically, are they very heavy standards? Or are they more of disclosure? So if you see the nomenclature, S1, S2 both speak about disclosure. IFRS 18, that is Ind AS 118, talks about presentation and disclosure of financial statements. And even if you look at IFRS 19, that is Ind AS 119, deals with subsidiaries without public accountability, but the focus will be on disclosure. So disclosure probably from the year-end perspective, when we are advising our clients and regardless of the size of the companies, so the idea is to make sure that the disclosure norms are actually followed at the ground level. And I would request all my learned members, my colleagues on this platform, to kindly go through the ICAI Ind AS disclosure checklist. So the Accounting Standards Board has brought out a number of useful, practical, handy publications, and kindly go through that. You will get further standard-wise disclosure norms, which will be very useful for us, not just for closing the accounts, for finalization, but also as an auditor, because as an auditor, we need to review whether the Ind AS compliance has been achieved or not. Recently, the ICI announced phased applicability for the guidance note on financial statements for non-corporate entities and also for the LLP. So changes coming continuously. Here we see Ind AS 118, and of course, at this juncture, going forward, as we move into financial year 26-27, Ind AS 118 comes more of a change, a challenge. Why? Because Ind AS 1 will be replaced by Ind AS 118. So the old and bold standard Ind AS 1, which has been dealing with presentation, disclosure, current, non-current classification, which we have been studying, analyzing, and using for such a long time, will have, I would say, has a very short lifespan, and it is going to be replaced very soon. So Ind AS 118 will be applicable for all entities, no exemption whatsoever, and the profit and loss statement would now be classified under five heads. So income and expense from operations, from investing activity, from financing activity, from deferred tax, that is income tax, and discontinuing operations. So five. So operations, income expense from operations, investing, financing, discontinued operations, and income tax. Five. So somewhat similar to cash flow statement. But then the standard also deals with MPM, management performance measures. And as a result, this standard will be definitely a lot of change will happen this year. Why? Because the Ministry of Corporate Affairs, under the advice of the NFRA, has issued the likely date of implementation, and this is from 1st of April 2027, exactly 1 year from today. Of course, we know early adoption is always permitted, is encouraged, but then this will be a change. So we can see existing standard Ind AS 1 will be superseded by 118. Just like in the insurance sector, Ind AS 104 has been superseded by Ind AS 117. That is the reason why Ind AS seems to be a very volatile, it changes. Continuous amendments keep coming. And definitely, this is one of the examples. ICAI has brought out a number of ITFG. If you look at the Accounting Standards Board, the Ind AS Transition Facilitation Group. So I request all my learned members, colleagues, and all our professional colleagues here to kindly refer to the ITFG bulletins. A number of bulletins have been brought out by the institute, and if you see, almost all the standards are covered So the ITFG bulletins cover critical areas. Probably, you see, every standard is generic. So a standard may not give you answer to all scenarios. That is why we need to understand, analyze, interpret the standards. And we have expert advisory committee and so on. So therefore, the ITFG bulletins, more than 23 bulletins have been published. So it covers almost 140, close to 140 issues relating to almost all the Ind AS, plus Schedule 3 to the Companies Act and other relevant issues. So this is also going to be very useful, handy, and it will provide us with the right navigation so that we are able to critically check whether the financial statements are actually displaying the transparency, the integrity, and the disclosure requirements. So this brings us to the FS, financial statements. And as part of the closing year-end considerations, it is pertinent to note that the requirements of Ind AS Schedule 3, as well as critical sections of the Companies Act, every organization, every entity, reporting entity needs to ensure that assets, liabilities, proper classification. So we will come to Ind AS 1 when we move to standard-based discussions, but then asset liability classification, current, non-current classification, depreciation calculation, whether all the notes to accounts, the required disclosures have been given. And in totality, all these individual compliances will give rise to what we call true and fair. Any mismatch, any lacuna, any gaps will definitely result in audit qualification, at least could be, it may not be a qualification always, but it could be in the nature of emphasis on matter paragraph, or it could be even in the most serious cases, it could result in an adverse report. So here again, time and again, every year when we start with the closing, the finalization of the accounts, we have to quickly check whether the requirements of 128, section 128, 129, 133 regarding compliance with the notified Ind AS is important for everyone. Plus the Companies Act, after section 134 was notified, the director's responsibility statement. So all the, not only the finance head of an organization, even those charged with governance, the board, the audit committee. So we will see that financial reporting, consideration of year-end items, compliance of all the Ind AS, plus the requirements of other legislations is not just the operational target, or I would say the responsibility of the finance function, but ultimately the board of directors, because we can see 134 subsection 5A clearly puts the onus regarding transparency, regarding integrity, regarding compliance on the board. So whether directors have selected the right accounting policy, whether all the Ind ASs have been complied with, going concern assumption. So these individual points of responsibility have been now put on the board, on those charged with governance. So during the year-end procedure, a quick review of 128, 129, 133, and 134 puts us in the right perspective, and that gives us the intention of the legislation and what we are supposed to do and how we are supposed to meet the objectives. So coming to the year-end, first, as we saw, inventory of the Ind AS. Every organization needs to have a complete inventory, that these are the standards which are critically important, because we will see there have been instances pointed out by different regulatory bodies, by the Financial Reporting Review Board, instances, for example, company receiving government grant, but in the notes to accounts, they have never mentioned the accounting policy for government grants. Similarly, issues have been pointed out where even if you look at by the Comptroller and Auditor General, the CMAG, that certain standards, accounting standards, Ind AS, for example, Ind AS 110 on consolidation, lacuna have been found, gaps have been found. So inventory, which are my important Ind AS, And how do I make sure that I am able to comply with each of the standards? What are the checkpoints? What are the compliance requirements of the standards? This is first. Second, critical area liabilities. Liability reporting. So whether it's the ICAI, whether it's the regulators like NFRA, every organization, every regulatory body has been focusing on some sort of serious issues regarding non-reporting or under-reporting of liabilities. So liability reporting is a major point. Objective review of some of the standards where we have witnessed certain amendments during financial year 25-26. Very important. We will cover all of them in Ind AS 1, Ind AS 7, which deals with supplier finance arrangements. Ind AS 12, of course, Ind AS 12, not much of there's no major guidance as such. It's just a small formality which has been issued in line with the Pillar 2 requirements, OECD requirements. Ind AS 21, we will see something regarding exchangeability. Ind AS 110 and EAC. So objective review of each of these standards, the changes in the standards. So in my organization, whether these standards have been duly considered during the finalization and whether the disclosure requirements are met. Evaluation of assets and liabilities. Now, in the last 2-3 months, when you think of the tariff war, then the attack, whatever has been happening, geopolitical crisis, from the war, from the uncertainty, a lot of questions are being raised from the business point of view, from the financial point of view. For example, what will be the extent of fair valuation, any type of impairment in the valuation, whether the expected credit loss, ECL, plus whether there will be huge amount of foreign exchange fluctuations. There could be instances that if the war, if this particular debacle persists, there could be adverse circumstances on financial reporting as well. So valuation of assets and liabilities, including fair valuation, impairment testing, ECL, critical important for year-ending purposes. Whether all management assumptions and estimates have been disclosed. So if you see, I have been writing this in the form of a small phrase, I love. You can see LOVE, love. And now we have CA. So C, consideration of year-end transactions. So different type of transactions will happen, provision, writing back of certain provisions, reversing of certain provisions. Certain items could be written off. So certain items, there could be a write back. So these need to be critically checked. And finally, the accounts closing and getting ready for audit. So this is just like, I love CA. So this is how I have tried to put in the important parameters which we need to ensure, or especially for year-end consideration planning for the financial year 25-26. Now we quickly look into one of the biggest updates of today, that is Ind AS implementation in the insurance sector. Now the IRDA has issued an exposure draft. This came out in the first week of March regarding implementation of Ind AS. So from the professional point of view, here we all are practitioners, chartered accountants, and of course, most of us probably we are already working in Ind AS. So going forward, several companies in the insurance domains will be in a position to implement Ind AS, specifically Ind AS 117 insurance contracts. So this will provide a lot of advisory and consulting opportunities to different CA firms all across the country. So if you look at the headlines, Ind AS will now be implemented across the entire insurance ecosystem, including life, general, standalone health insurers, reinsurers, and global best practice, as we call it. So insurance accounting 117, for example, that is IFRS 17, already implemented in majority of the developed economies, including EU, Australia, Gulf nations, Singapore, and so on. So the current insurance accounting framework, which was being followed recent times, have been focusing on incurred loss model, but now this will move to an expected credit loss model, more like an ECL model. And stakeholders were told that, okay, by 24th of March, You can submit your feedback to the IRDAI in response to the exposure draft. And finally, the IRDAI has said that the official date for mandatory adoption is 1st April 2026 today, with the option for a 1-year forbearance. Now, there could be certain insurance companies who might face genuine hurdles in the process of implementing Ind AS. So Ind AS 117 itself is a major challenge. So for genuine cases, a regulatory relaxation is being provided that, okay, the regulator is saying that, okay, we understand that it is difficult for you to overnight, you cannot change your accounting system, your data, how you capture data, right? And how you, even a major challenge would be training and capacity building of the entire accounting department, finance and accounts department. And when we talk of insurance, we have to think of actuarial department, we have the finance department, investment department, and so on. So a 1-year forbearance has been given, but this again has a rider. Those organizations in the insurance industry who have genuine issues, they need to submit their correspondence by the 30th of April with a board-approved plan, and till the time. So 1 year sort of an exemption is given. But during this period, they must actively proceed with the intention, with the activity, with the initiative of implementing Ind AS, plus they need to bring out Ind AS accounts as well. Now, looking at some of the recent press, so I thought of just sharing the Hindu Bureau yesterday, 31st March. So a few screenshots. IRDAI approves Ind AS framework for insurers from 1st April. You can see the second one I've shared is Business Standard, 31st March, yesterday. IRDAI notifies Ind AS norms, allows 1-year forbearance. So the implementation of Ind AS will be a mammoth task for the IRDAI, for the insurance companies. And you can see that the IRDAI has approved a major amendment, and that is the IRDAI AFI, Actuarial Finance and Investment Functions Amendment Regulation 2026. So 1-year forbearance is provided. During this period, business entities, reporting entities need to continue to submit Ind AS based financial information to IRDAI. Of course, they may not, as we understand from the exposure draft, they may not, or they, in case of genuine hardship and challenge, it is not expected that they will implement all the standards, but the process has to start, and they must back up with a board-approved plan of action so that they will be able to transition to Ind AS after 1 year. And the press reports clearly state that the ICAI and the Institute of Actuaries of India, IAI, have welcomed the adoption of Ind AS for the insurance sector. So this is a massive, I think a massive change which is going to happen. Of course, there will be hurdles, as we have seen earlier during our experience of implementing Ind AS for the non-banking or the non-insurance sector, the general industry. There have been initial hiccups, challenges, but these will be ironed out slowly with the passage of time. This is the exposure draft, and here clearly the IRDAI has referred to Ind AS 117 and the fact that 117 will move from the incurred loss model to the expected credit loss model. Plus, you can see that the financial statements prescribed forms, including the segregation of policyholders and shareholders' funds, complying with the accounting standards. So you can see actual valuation of investments. So these are critical areas for the insurance sector. Plus, a little while back, I was referring to section 128, 129, 133, and 134 regarding the responsibility of the board of directors. So you can see section 2.3 on this slide, the applicability of the Companies Act. We can see that the same standards have been highlighted by IRDAI. Plus, segment reporting going concern. And of course, segment reporting includes the 108, Ind AS 108. What will be the operating segments? Finally, the IRDAI has given us a difference in the exposure draft. Key differences between the existing standard followed by the insurance sector and Ind AS 117, which is going to be implemented very soon from this year onwards. So this is where we stand so far as a recent update is concerned. Now we go into the year-end considerations. We will now delve into the standards, and we are going to cover multiple standards. First, a small checklist, which could be useful for finance controllers, of course, for head of finance, and definitely for the auditors as well, because the closing of accounts, the finalization of the accounts ultimately signals that, yes, the financial statements are ready and it is ready for audit, and therefore the auditors definitely will find this checklist somewhat useful. So first, what we have been doing, when we check the readiness of companies. Now, most of the business entities, reporting entities, they have prepared annual closing checklist. So an SOP, a standard operating procedure, that what is going to be my annual closing checklist. So like we have accounts manual, so do we have a manual for the closing? Because financial year ending and year-end considerations involve a lot of stuff, because you are now wrapping up your business for the entire year, your business reporting, and therefore each and every standard Ind AS will be applicable. So therefore the entity needs to consider whether they have introduced the latest changes. Now, sometimes we see amendment in Ind AS, and if you look at the circular, it clearly says that the notification clearly says that, okay, this Ind AS change will be applicable from the date, from the even date, from that particular date. So whether changes in Ind AS, there could be certain guidelines coming from MCA, ministry. There could be certain observations of the C&AG. Also, during the closing of accounts and finalization, reporting entities need to carefully consider whether there is any expert advisory committee guidance from the ICAI. Several valuable guidance have been issued by the EAC. And if you see, as I was mentioning, every situation in a company, every scenario, a solution to every scenario cannot be there in any particular standard. That's why after the main standard, we have Appendix 1, 2, 3, and so on. We have application guidance. We have implementation guidance, AG, IG, and so on, because the standard is usually generic. So therefore, as if I am closing the accounts of my organization, I have to, for my year-end consideration, for assets and liabilities, I have to look at the changes in the Ind AS which have taken place during the financial year, which have a direct impact on the reporting date, plus any guidance from MCA, C&AG, if I'm a PSU, of course, NFRA instructions, and the ICAI Expert Advisory Committee guidance. Of course, cut-off procedure, that is another important part which needs to be robust as well. Next is the fourth point, whether for year-end purposes, reconciliation of accounts payable, accounts receivable, specifically goods in transit, consignment sales, whether billing versus dispatch reconciliation has been done. Then comes the important point, physical verification. So if you look at the standard closing checklist of any of the large companies, definitely we will find these important points. So physical verification of property, plant, and equipment, the location, the condition of the assets, whether the asset exists or not, a big question. Similarly, apart from PPE, Ind AS 16, definitely inventory, Ind AS 2, and of course, cash verification. Here again, investment property, Ind AS 40, also will come within the bucket, number 5. Number 6, impairment testing. So the sixth point in the year-end consideration checklist would be to ensure whether we have proper impairment testing of PPE. Now here one question has come, which CA Rahul has sent, and also I received it from CA Nitish Agarwal, our moderator, our respected moderator for the session. Now one question I am discussing here is that the question is, in case of idle machinery or assets not in use for a significant period, are we required to test for impairment at year-end, even if there is no clear external indicator? Now, this is a lovely question. I must thank CA Nitish Agarwal and CA Rahul Navani for including this question. Now, the as per my understanding, now Ind AS 36 deals with the impairment testing, and it deals with two types of impairment indicators, external and internal. Now, according to the question which has come from one of our esteemed member, in case of idle machinery or asset not in use for a significant period. Now, in my recent experience of handling some large-scale audits for manufacturing companies, if you think of large machinery, say a transformer, switch gear, a blast furnace, electric arc furnace, or it could be something like a rectifier, it could be something like maybe an inverter. Okay, so if an asset, a machinery or item of PPE is not in use for a significant period, so what will happen is it will lose its operating capability. So you know that all items of equipment, PPE, as per the question, machinery, okay, so this requires periodic maintenance. Even if you think of your car, if the car is kept idle, well, the battery will discharge. So even though there may not be any external indicator, but there is bound to be certain internal indicators. Right, so there could be situations where scenarios where we can find out that yes, these assets, these idle machinery will now probably, because no maintenance has happened, these machinery were not in operational condition. So what will happen? It will now probably pull in more power, number one. Number two, it will have more frequent breakdowns. Okay, it might have, as when we do the checking in the factory, in the shop floor, we try to review the MTTR, the mean time to repair, the MTBF matrix. So using that, I'm sure we will find internal indicators. And in the spirit of Ind AS 36, I would request the management of any reporting entity, if they have idle machinery not in use for a significant period, are we required to test for impairment at year end? Now, even if there is no external indicator, there could be certain internal indicators. So Ind AS 36, in the true spirit, I think we should carry out impairment testing for idle machinery or assets not in use. Distinctly, we remember cases during the pandemic when a whole lot of assets, right, were absolutely idle. And in several cases, several reporting entities, they actually carried out impairment testing, and they found that considerable, significant impairment loss came out once the entire exercise was carried out. That means the book value versus the value in use versus the net realizable value. Definitely there will be certain important parameters. So this was my response to one of the questions. Next, number 7 is depreciation, deferred tax. Okay, so year-end adjustment. Whether the entity is preparing financial statements as per the amended Schedule 3 requirements, plus another point we have to remember, this is outside Ind AS, but a point which is very significant, that is audit trail. So ultimately, financial statement is a summarized position of the entire transactions taking place in the year. We have profit and loss statement to show the performance. We have balance sheet to demonstrate the position, financial position, and we have the statement of cash flow to summarize what is my opening cash, cash equivalent, what is the net cash generated, what is my closing. Essentially, these are summarized versions, okay, statements to which is actually capturing the entire transaction for the year. But we know audit trail requirement. So therefore, one of the responsibility during the year-end consideration of the closing formality process flow will be to check whether audit trail is maintained. Number 9, from the audit perspective, whether during the closing and accounts being finalized. Now, some of the companies, especially in the PSU category, central public sector entities. Now, C&AG has issued, say, for example, some concerns. They have raised certain concerns or reservations in the earlier audit report, or they have flagged certain inconsistencies or non-compliance with Ind AS. We will come to some of them a little later. Now, the question is whether the entity during the closing, so when I'm closing the accounts, my next target is undergoing the entire process of audit. So I must realize, I must consider that fine, my accounts are ready. I am checking the compliance with Ind AS. I am looking at year-end transactions. I am checking whether there is any new guidance coming from the MCA or from the ICAI, from C&AG, from NFRA, and also there could be industry-specific guidance. For example, IRDAI, RBI, and so on. I'm doing the reconciliation, fine. I'm also taking care of physical verification, valuation of my assets, impairment testing, but am I also preparing the action taken report, ATR? So this, in my understanding, could also be an important part of the year-end consideration when it comes to assets and liabilities, because persistent observations, repeated observations of the auditors, if it is not addressed, this itself raises question about integrity, transparency, and so on. And last but not the least, one of the checkpoints could be that, do we have a plan for audit readiness, statutory filing, then of course board and ACM, audit committee meetings, and so on. So this is the snapshot of a 10-point practical checklist for finalization. Now, specifically talking about, of course, some of the important standards, right? So depreciation, amortization, we have seen. One more important point is in case of large companies, and of course now applicable across the ecosystem. Apart from I was talking about audit trail. One more point is definitely IFC, internal financial control. So whether the internal control over financial reporting, so probably during the closing process, the finance head needs to review that, is my RCM, my risk and control matrix, is it updated? Is it complying with the international best practices? Now here I also want to just add one point. If you look at CAG's instruction under section 143 subsection 5 of the Companies Act, instructions to statutory auditors, probably last year, probably May 2025, the C&AG office issued revised instructions under which statutory auditors of PSE, public sector entities, apart from the usual requirements of audit and CARO, they have to check 4 additional areas. And these areas will be under the purview of audit from this particular financial year. First, they have to check whether fair valuation is done properly. So Ind AS 113 plus actuarial valuation. So Ind AS 19, employee benefits. First point. Second point, if you see, the C&AG office has said that for companies, for entities which are receiving grants, financial assistance from government. Now, it could be the central government, the state government, it could be a revenue grant, a capital grant, it could be in the nature of a concessional loan, for example. So any type of financial assistance which comes within the ambit of Ind AS 20, whether these, whether the internal controls are in place, and most importantly, the question is that whether the IFC, internal financial control, is operating properly. So non-compliances, so any weakness in accounting, any weakness in financial reporting actually shows that the entire financial control is weak. Recently, just unfortunate, but certain names have to be taken for the last few years. Now, when we think of the banking sector, questions have been raised about IndusInd Bank. Okay, recently, even last year, there have been some disturbing questions on Gensol Engineering. This year, in the month of February, IDFC First Bank. So several questions have been raised due to certain lacuna in the financial control IFC process. And this is the reason why this point is equally important during the closing. Plus, we can see during this year, we now move to the standards. MCA has already made amendment through the company's Ind AS Second Amendment Rules 2025, which has brought amendments to several Ind AS. Plus, during the year, new labor code, which has created a massive impact on employee benefits or defined benefit plans. So revised definition of wages. Now, even if a person is a contractual employee or labor worker, for example, satisfying certain conditions, they are eligible for certain benefits, retirement benefits. So that means the entire plan, the defined benefit plan, there is an amendment in the plan, which means that there will be a difference in the past service cost. So as a result, there will be changes, increase in the liability, in the employment, in the actual valuation as well. Also, the rate of increase in the salary, maybe we assume 10% when the actual evaluation was carried out. But looking at the global headwinds, looking at what is happening in the geopolitical scenario, looking at the recent cases of massive layoffs, maybe company reconsiders and says, no, I cannot offer a 10% increase in salary. So many of the assumptions which are inputs for doing the actual valuation will go for a change. Any change means impact on the past service cost. Automatically, it will, I hope you can understand that it will directly hit Ind AS 19. So these also have happened in the last 1 year. Coming to the first one, Ind AS 1, very important. So we'll cover just 5 standards. First and foremost, if you see 13th of August last year, some changes were introduced in Ind AS 1. Certain changes, if you see, were applicable for financial year 25-26. And 1 or 2 changes are there which will become applicable from today, that is for financial year 26-27. So we are now trying to see the question, what are the major changes which we have to consider as part of year-end review process, specifically for financial year 25-26. Now, talking about the first one, we can see that there is an amendment regarding current, non-current. And the idea is that classification of liability as current or non-current will purely depend on the management's ability to settle the liability, the right. So the right to defer settlement. So if the management has the right to defer the settlement of the liability, only in that circumstance, it will be seen as non-current. Another scenario can happen. Management has already thought that, okay, this is a non-current liability, but maybe during the next few months, that means between the date of the balance sheet, 31st March, and say the accounts are adopted on 15th of June. So within this intervening period, maybe the management is able to pay off the liability. So what to do in that case? So therefore, liability, specifically if you see where the right to defer settlement is conditional, that is, liability can still be classified as non-current. So what happens is, provided the entity complies with the specified conditions at the reporting date. Now, most importantly, for financial year 25-26, what we have to check is, if the entity had right to defer the settlement as on the reporting date, that means as on 31st March, the entity has the right to defer the settlement, liability shall continue to be presented as non-current. But disclosures need to be given so that the users can understand that on what basis the reporting entity is classifying this particular liability as non-current. For this particular year, financial year 25-26, an entity specifically, there's a sunset clause. So sunset clause clearly says it addresses situations involving breach of loan covenants. That means during the financial year, say during the financial year before the end of the reporting period, there is a breach of a particular covenant or a requirement for borrowing. Maybe the entity was supposed to maintain a particular ratio. Okay, current ratio should be so much. Debt service coverage ratio should be so much. Interest coverage ratio should be so much. Or maybe it is in the nature of a sustainability requirement. Okay, so any breach which has happened before the reporting date. So in this situation, a long-term borrowing, there is a breach in any of the covenants. As a result, the loan now becomes a loan which is on demand. That means it becomes, there is a breach. As a result, the liability is becoming payable on demand. In this situation, the reporting entity can show it and classify it as a non-current only for financial year 25-26, provided that after the end of the reporting period and before the approval of the financial statements, the bank comes and bank means the lender here, comes and tells me that, okay, we are waiving, you have not been able to comply with out of 5 parameters, maybe 2 parameters you were unable to meet, you were unable to say comply with. So technically speaking, we can call back the loan, but we will not do it in view of our business relationship, in view of other policy matters. So we will not demand repayment. So if this has come, if this communication comes, then the entity is basically eligible to show the particular liability as non-current for 25-26. But the sunset clause clearly says that this can be carried out only till 31st March 2026. For the new financial year, which starts from today, 26-27, there will be a change. So looking at how the change has happened, now one more point is management's, I was mentioning this, management's intention for early settlement does not play a role in classification of liabilities. For example, maybe a loan is categorized as non-current. Now, if the management intends or expects to settle the loan within the next 12 months, the question is, the management is thinking that, okay, we are expecting or intending to settle the liability in the next 12 months. Still, it will be shown as non-current. This is what the amendment says. Now, if you look at some of the excerpts I've taken from you can see the notification. 13th of August 2025, you can see clearly it says the rules are known as the company's Ind AS Second Amendment Rules 2025. They shall come into force on the day of their publication in the Gazette. The day of publication, you can see, is 13th August 2025. What does Para 73 say? Para 73 is saying, if an entity has the right at the end of the reporting period to roll over an obligation for at least 12 months after the reporting period, it classifies the obligation as non-current, even if it would otherwise be due within a shorter period. Point number 1. Now we come to point number 2, Para 74, where there is a breach of a material covenant of a long-term loan arrangement on or before the date of the reporting period, with the effect that the liability becomes payable on demand. The entity does not classify the liability as current, which I was mentioning. It will still show it as a non-current, but disclosure has to be given, provided this non-current classification will be allowed, provided, what does the notification say? If the lender agreed after the reporting period and before the approval of the financial statements not to demand payment as a consequence of the breach. However, definitely, in this scenario, the entity shall disclose information according to Ind AS 107. This, I will call it a flexibility, or this particular treatment is allowed only for 25-26. From 26-27, from this new financial year, which starts from today, it will change. So if you look at this particular slide, we are on slide number 19. If you see classification of liabilities as current and non-current, if you see the slide, you will see it is written that, however, this is line number 4 of the paragraph 139U. It says, however, for annual reporting periods beginning on or after 1st April 26, that is from today, entities need to follow a new accounting treatment, another 74. We have a different paragraph 74. What does 74 now say? Till 25-26, the rule was that, okay, during the financial year, company has violated a certain covenant. As a result, the loan which was seen as long-term borrowing now becomes a loan which is payable on demand. Technically, it becomes current. If the lender exercises its right and calls back the loan, if there is a recall. But if the lender comes and tells me that, okay, we understand your issue, it's a genuine business problem, industry scenario issue, geopolitical risk, we appreciate, you are not the only one, other companies are facing the same debacle, and we will not recall the loan, we will not demand the loan back. This communication has come between the date of closing, that is 31st March, reporting date, and the date on which the financial statements are adopted. In this intervening, that means this is Ind AS 10, basically we are referring to. Post-reporting. If this communication has come for financial year 25-26, the rule was show the particular liability as non-current. But from 26-27, please see what the paragraph says. Now, even if the particular banker comes and tells me that you are we are giving you a waiver. You have violated a particular requirement. You have breached a particular covenant of the loan. In spite of that, we are not going to recall the loan. In spite of this communication coming from the lender, the entity cannot show the particular liability as non-current. They have to show it as current. Now let us see what the paragraph 74 says. This is for financial year 26-27. Please see, when an entity breaches a covenant of a long-term loan arrangement on or before the date of the reporting period, same scenario. That means breach has happened during the financial year. As a result, on the reporting date, the liability becomes payable on demand. Now the rule is we cannot show it as non-current. We have to. The new paragraph 74 says it has to classify the liability as current, even if the lender agrees to waive the particular, that means the lender will not recall the loan. The lender is granting a waiver. In spite of that, the entity will show that particular liability as a current liability. And if you see para 74 clearly says, this is the notification, the new para 74 of revised amended Ind AS 1 says an entity classifies the liability as current. Why? Because at the end of the reporting period, it does not have the right to defer its settlement. Because at the end of the period, the fact is we have breached one of the loan covenant. Due to the breach, the loan is now payable on demand. So I have to show it as a current, not as a non-current. Para 75, last one. However, if the lender comes to me before the reporting period is over, maybe on 28th of March, and says that, okay, you have violated a particular covenant. It's a serious non-compliance with our lending rules. We will, however, issue a waiver. We will not take any punitive action. We will not recall the loan. This communication is coming to us on 28th of March. So if you see para 75, that means as on the reporting date, as on 31st March, I know, the entity knows that they have received a waiver. That means the loan is not going to be payable on demand, and this communication has come before the reporting date is over. Para 75 now says, in this situation, I will show it as non-current. So what the para 75 says, however, an entity classifies the liability as non-current if the lender agrees by the end of the reporting period to provide a period of grace. That means at least 12 months after the reporting period. So this is a major change, and this is what has happened before. That is for financial year 25-26 and for financial year 26-27. Basically 26-27 onwards, Ind AS 1, this particular instance, it is a carve out. It is a difference between IS 1 and Ind AS 1. This carve out is now getting removed from this financial year. So this is we are actually, this 1st April is also, I would say, a watershed, a transition between accounting treatment for Ind AS 1, current, non-current, but we are now moving towards a more globalized system of accounting. So this is Ind AS 1. Now we see Ind AS 8, not much of change. It's the same issue, just during the closing formalities as part of the year-end considerations, we need to be mindful about accounting estimates and accounting policies. And for example, depreciation, change in depreciation will be seen as, of course, it's a change in accounting estimate. Accounting policy change, we could think of maybe change in method of amortizing actual gains, or cash flow statement we are preparing. Is it direct or indirect method? So this could be seen as an accounting policy change. So just during the year-end closing, year-end consideration, we need to make sure that we have to follow the principle of Ind AS 8, that all accounting estimate, any change in accounting estimate will have a prospective application. Any change in accounting policy will have a retro application. So this is the only point for Ind AS 8. We now move to Ind AS 10, and Ind AS 10 talks about adjusting events and non-adjusting events. Plus, it deals with date of approval of the financial statements. Different examples of adjusting events could be there. Practical scenario for financial year 25-26, in view of the geopolitical crisis, and also a lot of uncertainties, volatility in the global environment, bankruptcy of customers. This could take place, litigations could take place. So these ideally will come within the ambit of Ind AS 10, which is, in my understanding, a critical standard for compliance, specifically for financial year 25-26. Next is, of course, let us look at one example which actually flows from our previous discussion. And let me come to this. We were discussing about the company's Ind AS Second Amendment Rules 2025. Now, this is the first, 13th August. So what the Ind AS is now saying, Ind AS 10, the change in Ind AS 10, which has a direct bearing on the year-end consideration, is that, as we saw, that classification of current, non-current has been changed. Plus, from 1st of April 2026, we saw that companies reporting entities need to follow new guidance specifically for cases where there is a breach of a loan covenant. Now, here, para 76, which we can see in the lower part of the slide, becomes very useful for us, because when we are doing the closing, now what will be seen as adjusting and non-adjusting? We have a small checklist. Para 76 says, if you just have a quick glance at the slide, if the following event occurs between the date of end of the reporting period, that is 31st March 26, and the date the financial statements are approved, then these events will be disclosed as non-adjusting. That means no revision in the underlying value, in the carrying amount. What are the 4 conditions or 4 instances given? So very handy and practical case. Refinance on a long-term basis of a liability which was classified as current. So it's a non-adjusting. It will be a non-adjusting event. Rectification of a breach of a long-term loan arrangement classified as current. So there was there has been, say, for example, some rectification. There was a breach of a loan covenant. As a result, it was shown as a current liability. And during this intervening period, there has been rectification of the breach. Will it be adjusting? No, it will be non-adjusting. So no change will be carried out in the classification part. Number 3, point number C, granting by the lender of a period of grace to rectify a breach of a long-term loan arrangement, which was classified as current. This also, it will be a non-adjusting event. Lastly, settlement of a liability classified as non-current. This is something which I was referring to earlier as well. So there's a long-term liability, a non-current liability as on 31st March, but it has been settled during this intervening period. That means from the date of the balance sheet till the date when the accounts are adopted. That means the financial statements are approved for issue during this period. If the settlement of liability has happened, yes, it will also be treated as non-adjusting. So these are the major changes in Ind AS 10, which will have a direct bearing on our analysis for financial year 25-26. Some cases I have given here. Let us see what is the date of approval for issue of financial statements prepared for the reporting period. Some dates are given. So the financial year is April 1, 25 to yesterday, 31st March 26. Say, for example, completion of financial statements prepared on May 28. The board has reviewed and approves the financial statement for issue on 19 June. It is available to the shareholders on 1st July. Annual general meeting is on 15 September. It is filed with the regulatory authority on October 16. Okay. So what will be the question is that what is the date of approval? So as we can see, date of approval according to Ind AS 10 is very clear that the date is when the financial statements are approved by the BOD, the Board of Directors, and corresponding approving authority for other companies. So in this case, it is going to be 19 June 2026 when it's approved. The second example, we see some fraud here. The company is taken Ghotala, the Board of Directors of Ghotala Limited. They have approved the financial statements for reporting period 25-26. Say it is date of approval is 15th of June. The management discovered a major fraud. Now we have, I was mentioning some examples which have been haunting us for the last 1.5 years. So many cases which actually steal the headlines today. Recently, including a bank, Chandigarh, you can understand the case. So management discovered a major fraud and decided to reopen the books of accounts. The financial statements were subsequently approved by the board on 30th June. So initially 15th June it was approved. After that, a major fraud was discovered and the management decided to reopen the books of accounts. So we know the relevant section 130, 131 of the Companies Act. And finally, assuming that on 30th June, the financial statements were subsequently approved. So what will be the date of approval? As per Ind AS 10, it will be definitely the date when the financial statements are finally the final date of approval. In this case, it is 30th June. After reopening the accounts, after reviewing the financial statements, the management, that is those charged with governance, the BOD here, they have approved the financial statements for issue. So 30th June is the due date. Let me take the fourth one. A company, Border Limited, receiving a demand notice for additional amount of 28 lakhs from GST department on account of higher tax levied by the department. Say that this is for financial year 24-25. Accounts are approved. Financial statements are approved on 10th of August. Now in July 2025, that means before the financial statements were adopted or approved, the company had appealed against the demand of 28 lakhs and the company has an expectation that they can settle the demand for around 15 lakhs. Question is whether these events are adjusting or non-adjusting. So in this situation, the demand notice was received on 15th of June. That means it is a date which falls between the closing, that is 31st March, and the date when the financial statements are approved. And it is so we can call it, in spirit of Ind AS 10, it is an event after the reporting period. Accordingly, the demand for additional amount has been raised because of higher rate of GST. So it will be seen as an adjusting event. And in line with Ind AS 10 and Ind AS 37 on provisions and contingencies, Border Limited should create a provision as per best estimate. And in this case, since their estimate is 15 lakhs, a 15 lakh provision may be created. The last case, also practical issues here. A company, Dawn Limited, had taken a large-sized civil construction for a public sector. The value of the project is 2,000 crore. And the project started, the execution phase started during 24-25. During the course of execution on 29th May 2025, the company found that while raising the foundation work, it meets with a rocky surface, due to which the cost would go up by 150 crore. Cost would go up by 150 crore, which would not be recoverable from the contractee as per the terms of the contract. The company's financial year ends on 31st March, and in this case, how to treat the above. So if you see the execution of this large sized civil work started in 24-25, rocky surface, which was discovered later, was there at the end of the reporting period. Though the existence was evident little later, but the rocky surface was there. As a result, the condition was existing at the end of the reporting period, so it will be considered as an adjusting event, and accordingly the cost of the project and the profit should be accounted for accordingly. So this is Ind AS 10. Now we come to Ind AS 12, which is a very small and short and sweet relief. I will call it a relief for reporting entities. So let us see what it talks about. Now we all know that there is a concept of GMT, Global Minimum Tax. We all are aware about OECD, the Organization of Economic Cooperation and Development, and we have a very good knowledge of BEPS, which is basically base erosion and profit shifting. So the OECD brought out a number of guidelines. These are part of international tax, and the idea is to introduce a global minimum tax of 15%. That means if a company is working in operating in different nations, and say it is a resident of US, and it is found that in any of the nations, it is ultimately paying a tax, an effective tax, which is less than 15%. In that case, the difference Maybe the company is paying 11% tax, but the GMT rate is 15%. So this difference of 4%, the company has to pay like a top-up tax in the country where it is resident. So accordingly, OECD brought out number of guidelines. We had pillar 1. Later on, they brought pillar 2. So as you can see, pillar 2 clearly says that for large multinational companies, now what will be the focus area? The focus area is that for large multinational companies, they have to pay minimum 15% on the taxable profit. If they are paying any less than 15%, they have to pay a top-up tax. Accordingly, some rules were brought out. Now the question is, in this 12, the amendment which has happened clearly says that the Ind AS, the ministry is saying that in line with IFRS, in line basically with the International Financial Reporting Standards, reporting entities in India will get a mandatory temporary exemption. That means, as and when India is going to implement the GMT, the Global Minimum Tax, explicit disclosure under Indian Accounting Standard 1, Ind AS 1, because Ind AS 1 clearly says any issue regarding judgment needs to be disclosed. So this is the logic which I'm trying to structure and framing. So the analysis is that, so I'm giving some examples here. Case number 1, a bank purchases a supplier's receivable in a factoring arrangement at 95% of the face amount, and the bank requires the entity to pay only 98% of that amount. Fine. In this case, entity receiving the benefit is supposed to pay 100%, but now it has to pay only 98%. That means there is a substantial change in the liability terms. This is coming only because of the bank, the presence of the bank. So SF with the bank is allowing the entity to remit payment to the bank on a date which is later than the original due date of the invoice. So in this situation, this arrangement with the bank actually is extinguishment of the original liability. Please think of Ind AS 109 as well. So the trade payable is now extinguished, and in its place, we have a new financial liability. So this is one example. Case 2, AB Limited is, say, pursuing SFA. AB Limited is the purchaser, is the reporting entity. They are procuring goods and services through supplier finance arrangements. And they have a bank with them, XYZ Bank. XYZ Bank is such, the arrangement is such that they are getting extended credit period and they are paying interest. AB Limited is paying interest to the bank. XYZ Limited is saying that, okay, we are making upfront payment to the supplier based on the credit rating of AB Limited, which is the purchaser. Fine, but we want additional collateral. So the company AB Limited, in this case, the purchaser and the reporting entity, has provided additional security. Plus, in the books of accounts of the bank, this company AB Limited is recognized as a borrower. In this case, if you see, the nature of obligation has moved. Sorry, this AB Limited has moved. As a result, it will now show this as a borrowing in its books. It is no longer going to be a trade payable. It has to be shown as more like a borrowing, because additional security is provided, interest, and they are getting extended credit period. So the usual terms and conditions related to trade payable is not followed here. We have separate terms and conditions. So some of the factors which we need to consider before we identify that under which bucket, trade payable bucket, or is it to be shown as a separate line item, or is it to be shown as a financial liability, this will depend on several questions and the merits of the individual case. Is there any acceleration of payment? What is the purpose of introducing supplier finance? Is the supplier eligible to, say, for example, the supplier says that, no, I don't want to avail of any banking facility from the purchaser's bank. Are they eligible to get funding from other banks, other NBFCs, for example, other financial institutions? If additional security is provided as part of the arrangement, in that case, the liability will not be a trade payable. It should be shown as a financial liability. So now we come to the next part, the second and the third part, impact on debt covenants in this 7. So leverage ratio obviously will change. The moment we reclassify trade payable to borrowings, automatically my debt equity ratio increases. Second is, if any liability is shown as a borrowing, the final payment will be classified as a financing cash outflow. Similarly, as I was mentioning, there is a question of liquidity risk, concentration of debt with a single finance provider. If any time the finance provider withdraws this facility, that means if the bank withdraws the facility, the entity, the reporting entity, may face immediate fund crisis, liquidity stress, because now we have to make the full payment, maybe to the MSME supplier, within a shorter span of time. Okay, so this is my understanding of the second part of the query, my answer. The third is regarding legal novation versus substance. Under Ind AS 109, specifically, we always look at the substance as per my understanding. So a liability is de-recognized when the obligation is discharged or cancelled. So here, primary determinant will be the substance of the agreement, not the legal novation. Now, the last is determining of the ownership of risks and rewards. So here we can see that the entity receiving discounts or rebates, if it is such that the entity is receiving some discount or rebate just because of the involvement of the bank, or any other say factor is available, is applicable in this case, that means there is a risk, there is a shift in the risk and rewards. Second case is disclosure requirement in case of SFA. This is plain and simple because there has been certain revisions starting in 2023 when IS 7 and IFRS 7. So this is very interesting. Both have the same number, but IS 7 in India is Ind AS 7 and IFRS 7 in India is Ind AS 107. So we see 7 is a common number in digit in both the standards. So minimum disclosure requirement is clearly laid out by the international standards and also by the revision, the amendment of Ind AS 7. Separate disclosure to be given if the terms and conditions are dissimilar. If terms and conditions are similar, then we can go for aggregating. Next is any judgment. This is Ind AS 1. Any judgment which the management has adopted for identifying that this liability is it a trade payable? Is it a bank borrowing? Should it be shown as a financial liability or towards a bank? Or is it to be shown as a separate line item under the heading supplier finance arrangement? One can choose any one of these options. Now, the reporting entity may need to exercise significant judgment. So this will definitely qualify as a disclosure under Ind AS 1 as well. Next is the terms and conditions of the SFA in terms of extended payment terms, security, any guarantee. The bank may say that, okay, you have a good credit rating. We are providing funding to the supplier at a less than market rate of interest or a soft interest rate, but still because we have a volatile ecosystem and geopolitical risk, so we would ask you to provide some security or guarantee. So this is included in the terms and condition. So this has to be disclosed, plus the carrying amount of the liability. That means I am the reporting entity, opening balance sheet. This was my total outstanding balance. That means my financial liability at the beginning of the period with regard to SFA. And this is my closing position plus how am I out of the total amount. This is my opening liability, my closing liability. But I have shown this entire liability in which method? Have I shown it as trade payable? Have I shown it as bank borrowings? Have I classified it in my balance sheet under any other line item? Last but not the least, these are the liabilities for the reporting entity. That means the reporting entity has to pay off this amount to the bank. But for each and every item, the bank has already made disbursement to the supplier. So the portion of this liability for which the suppliers have already received payment from the finance provider, this also needs to be disclosed. So these are some of the factors. Last but not the least is, so as I said, that Ind AS 1 also gets impacted. The last question in the query was cash flow classification, how to show it. I am showing it through a table to simplify. Now, if I classify the particular, the liability as a trade payable, then in the cash flow statement, it will come under cash flow from operating activities. Logic I have given is liability is still considered part of the entity's normal operating cycle and working capital. On the other hand, if the liability is shown as a bank borrowing, it will be classified under financing activity. So this will be seen as a financing outflow, a cash outflow under financing head. There could be non-cash transaction, for example, when the bank is making an upfront payment to the supplier. It's a non-cash transaction from reporting entity's perspective. Okay, I am A, B is the bank, supplier is S, A, B, S. Okay, I am A, B, bank and supplier S. B is paying S, bank is paying to the supplier. It's a non-cash transaction from the perspective of A, but it should be disclosed outside the cash flow statement. Disclosure is important. Yes, this will involve, of course, a lot of data to be captured. Sometimes it could be challenging for the reporting entity to get this information from the bank as well. Okay. Lastly, I share a case study to illustrate this concept. Dhurandhar Steels, DSL, Dhurandhar Steels Limited, is purchasing raw material and other supplies from various suppliers. Fine. So we are assuming most of the suppliers are MSME. DSL has negotiated, let us see, they have negotiated. Okay, they have negotiated what? They have negotiated 180 days extended credit term. Bankers of DSL are agreeing to buy the bills endorsed by DSL. Fine. Now the question is, the suppliers decided whether they need to transfer the bill to DSL's banker. Suppliers can also get their bills discounted from other bankers. So this is a telltale sign. Last but not the least, if a supplier decides to get the bills discounted from DSL, the banker will consider DSL's credit risk. Fine. Finally, transfer does not release DSL from its liability towards the supplier. Just because a bank is coming in between doesn't mean that the purchaser, reporting entity, that is DSL in this case, Dhurandhar Steels Limited, they are absolved of their liability. No, they are very much accountable. Why? Please see the last line here. If DSL defaults in payment of dues, the banker can use the court procedure against DSL. But it will be done only and only through the involvement of the suppliers. Also, DSL does not receive any additional benefit. We don't have a credit line with the bank. Facts of the case. What type of funding? Is it to be shown under trade payable or is it to be shown under borrowing? Well, here we can see that DSL is fully accountable to the supplier. DSL is not getting any extra benefit because of the bank coming in. DSL is not paying any high rate of interest. They are not providing any guarantee. They are not forced or they are not required to offer any collateral. So therefore, we will classify this. Also, there is no extension of the payment date beyond the original date of the invoice. So it seems here again judgment. See, there is no hard and fast rule, but looking at the logical principle, Ind AS is principle-based, logic-based, as opposed to rule-based. So it seems that DSL, in this case, as per my understanding, it should classify the liability as a trade payable, not as a bank borrowing. So these are my responses to the queries which was sent by our esteemed member. Now, lastly, we see the few points here in Ind AS 110. Now, here the expert advisory committee, the question was that whether a Section 8 company or a trust, which is created to carry out CSR, so whether it can be consolidated. ESC Expert Advisory Committee of ICAI has said that given the facts of the case, a non-profit entity can be consolidated, and as a result, it is our understanding that Ind AS 110 talks about returns, it talks about control, it talks about varying rate of return. And investor should get the exposure to a variety of returns indirectly and directly from the involvement with the investee. So this is Ind AS 110, but we can see the Expert Advisory Committee has issued a very important guidance. So from year-end consideration purpose for financial year 25-26, this is equally important and should be duly recognized and considered when accounts are finalized. Last one we have is regarding the GHG, Greenhouse Gas, GHG. Now, in the Government of India, in last year on October 8th, the Ministry of Environment issued certain guidelines for greenhouse gases. Now, as a result, there are some greenhouse intensity targets which have been introduced for specific sectors like aluminium, cement, paper, and so on. And emission targets that, okay, if you are sustainable, then your emission should be below, say, for example, 15,000 kgs of carbon dioxide, something like this. compliance obligations are also there. Now, recently what has happened is 13th January, just 2 months, 3 months back, the Ministry of Environment, Forest and Climate Change, they notified greenhouse gas emission intensity target. Now, for financial year 25-26, this becomes an important sector, an important, I would say, principle or a factor to be considered. Why? Because GHG 2025 rules and the GHG amendment rules establishes a mandatory compliance regime. That means if my emission is more than, say, the rate is 15,000, or say, let's take 20,000. If I emit more than 20,000 kgs of carbon dioxide, I have to pay a penalty. I have to buy carbon credit. That means there is an obligation. And we know obligation are of two types. We have either something called, it could be a contractual obligation, or it could be more like a customary obligation. In either case, we are actually able to bring in, or we are able to draw some of the important principles of Ind AS 37. So if you look at Ind AS 37, that means is a present obligation. There is a probability that a cash outflow will take place and reliable estimate can be made. I am illustrating this important case for 25-26 with a small case. Company A is a manufacturing company. The GHG rules are applicable, and 31st March 2026 is the year end. And say, for example, we are taking a simple case of carbon dioxide emission. Compliance is monitored annually, and say the annual emission threshold, say, is 21 tons, that is 21,000 kgs. 1 ton is 1,000 kgs. Timeline is what? We find that for financial year 25-26, the target is 21 metric tons. Till 31st December, the company has emitted 15 tons. 30th January, that is within 1 month, the emission has reached 22 tons. That means on 30th January, it has exceeded the limit of 21 tons. So the analysis on 31st December, the company has emitted 15 tons, which is below the target 21. Because once you emit more than 21 tons, you have to pay. There's some financial obligation, some cash outflow will take place. As of 30th January, the company has emitted 22 tons. That means it has exceeded the allowable limit. And this is where the company has to assess whether the recognition criteria of Ind AS 37 is getting hit or not. So this is yet another important standard, Ind AS 37, with regard to financial year 25-26. We now come to the last 2 points. Yes. Rahul sir, we are just concluding in another five minutes, please. Okay. Finally, for the new labor code, please note that we have discussed about the changes which has happened and the fact that wages are now considered to be 50% of the total remuneration for statutory purposes. So as a result, ICAI has issued the guidance and FAQ, which clearly says that gratuity liability is definitely going to increase because now the code on wages has been changed. The new labor code has superseded and is now actually subsumed the earlier laws. As therefore, any change in the liability will be seen as a past service cost. Consequently, original obligation, say, was 1,000 crore, but now the obligation increases to, say, 1,500 crore. As a result, the additional liability has to be shown as an expense, and it has to be recognized in this particular financial year itself. So this was the last one on standards. And now recently ESC has issued 2 important guidance. One is regarding accounting for GST paid on lease rental, which needs to be considered, and classification presentation of accrued wages and salaries to employees. This is also going to be critically important for financial year 25-26. Lastly, the tariff and geopolitical risk. If you see, yes, this is only just a perception that looking at whatever developments are taking place from the accounting perspective, from the financial reporting perspective, this geopolitical risk tariff will have is already having a sustained impact on supply chain, And as a result, the possible effects which may have to be considered during the closing process by specific companies will include impact on fair value measurement, restructuring provisions could be there in Ind AS 37, revenue recognition 115, potential for contracts, onerous contracts can take place in Ind AS 37, expected credit losses 109, deferred tax asset obligation recognition, that is in Ind AS 12, lastly valuation of inventory in Ind AS 2. And worst situation definitely is hyperinflation. So Ind AS 29 may have to be considered only in exceptional circumstances. An impairment review for non-financial asset also will be considered. I will close with the last two slides where we show some of the important Ind AS, as you can see. Statutory auditors, this is specifically for the central public sector entities, but we can see that the statutory auditors have flagged some observations where it is seen that many Ind ASs were not followed. Here you can see Ind AS 1, 20, 109, 37, 36, and so on. And you can see on the left-hand side some very well-known names. And the last slide again here, and I'll close with this, we have some other companies as well, where we find Ind AS 7, we have discussed about that, Ind AS 12 we have covered, Ind AS 20 I was referring to certain cases, 36, and you have 109. And this shows that non-compliances with account Ind AS is definitely going to hamper because auditors will view it very seriously. And now with the NFRA guidance coming in, ICAI's overarching focus on the transparency of accounting statements, financial statements, and compliance. So we have to be very clear and also careful when we do the year-end adjustments and close the accounts for the year. So with this, I will pass on for the conclusion to our moderator, sir, and also to C. Nitish Agarwal, sir, and to Rahul Nawani, sir. Thank you from my side.
Thank you very much, Arijit sir. Thank you so much. And I think it's very rare of any professional to be able to cover such depth and coverage, such expanse of any particular topic in such a short amount of time. And I think your session has been truly enlightening. So with this, I would like to conclude with a vote of thanks to you, Arijit sir, and also our technical team, our office bearers, Rahul Lavani ji, who's also on the call and who's supported us through the journey, and also our chairman of the board, CA Sanjeev Kumar Singhal ji, vice chairman of the board, which is CA Vishal Doshi ji, and chairman of the ICI and vice chairman of the ICI and other office bearers. Thank you so much, and thank you for the wonderful session.
Thank you.